Good morning, good afternoon, or good evening to everyone connected from all over the world. Welcome to the United Nations Development Programme and Milliman's joint event, Understanding and Financially Managing Risk to Build Resilience. I'm Sandra from UNDP, joining you from what was an unexpectedly sunny Geneva. The weather forecast has changed, but it's my pleasure to be your host today. Our speakers and panelists in today's session will explore how seemingly unmanageable global risks and escalating financial losses can be tackled with greater risk awareness, risk modeling, and investing in resilience. Before we dive into the event, I have a few logistical items to share with you all. Please note that you're on mute. If you have questions, you can submit them via the Q&A feature, and we'll answer them during the session. For any questions we don't get to, the UNDP and Milliman team will definitely follow up with responses after the event. We are recording the session, so you can find it later on, both on the Milliman website and the UNDP Insurance and Risk Finance Facility website. You've probably also noticed we're on Zoom. We recommend you use the speaker mode for the best viewer experience, and you'll find that option in the upper right-hand corner of your Zoom window. With that, I'm going to launch into the session introducing our first two speakers who will be framing the nexus of global risk and financial resilience. Jan Kellett, UNDP's Global and Corporate Lead on Insurance and Risk Finance, and Dermot Corey, CEO and President at Milliman. Jan and Dermot, over to you.
Thank you. Thank you.
Thank you very much, Sandra, and thank you to everyone both joining us here in the room, but on also the many people who are joining us online. And welcome to this joint event with our friends at Milliman. So as Sandra noted, I lead UNDP's global work on insurance and risk financing, risk transfer, financial resilience, growing area of work, but certainly not keeping apace with the needs. I'm also framing this conversation thinking about what we just heard coming out of Baku, and it's great to have Carolina here from Santiago Network, perhaps to give her thoughts. But I think it's perhaps a bit of a stark reminder of the reality of financing when we consider about financial resilience for communities and countries in the front line of climate change and other sets of risks and hazards out there. I think maybe just to start it off, so UNDP's work in financial resilience in insurance has a very simple premise in part, which is to put financial resilience at the heart of development, which is surprisingly, perhaps for some of us, perhaps from some of our industry colleagues, has not necessarily been the case. If you think back to the Sustainable Development Goals, for example, which still are our guiding light in terms of development and working with countries, there is very little reference, if any, to financial resilience. There was not actually much reference even to the issue of risk within the first set of goals and then the targets which came out. And the guardians of the work on risk reduction inside UNDRR have done a sterling job on that over the last years and so. But still, financial resilience lags behind. And that has been part of our work within the insurance community, but also within UNDP since then, working, for example, to create the Insurance Development Forum, the Ocean Risk and Resilience Action Alliance, and indeed UNDP's own Insurance and Risk Finance Facility, which actually was only launched in 2021. Again, showing, if you like, that even within UN's development arm, the issue of financial resilience and insurance and risk transfer is relatively new, although not necessarily new programmatically, but in terms of having a dedicated policy and program team supporting all of our country offices around the world, relatively new. And it's worthwhile noting, and this is why it's great to have our colleagues here from Milliman, that working with industry is actually central to the way in which you work. And that's on two parts. On the one hand, we can't hold risk, so therefore we have to work with industry. We have to work with industry that actually can take that risk on their shoulders and construct financial resilience solutions. That's something which UNDP cannot do, so therefore immediately calls upon our work with industry. But in relation to that as well, we also do not wish to duplicate expertise which already exists out there in industry. And that's really where the partnership with Milliman came to be, I'd say, which is, why develop our own massive actuarial capacity when there are keen and entities such as Milliman who wish to deploy their capacity, expertise, talent to developing countries, why not harness that and deploy that through our country offices, which is really key for UNDP. And that's really the foundation of what we do is, in a sense, how can we work with industry to deploy technical and financial resources at scale at the country office level. So, okay, we are now working in 39 countries, but what I'd like to say is we're only scratching the surface. We've had in the last 12 months, 13 months or so, 43 countries which have come to us and asked for us support beyond the resources that we have. And we all know the statistics when it comes to issues of hazard, risk, and shock are only going in the wrong direction. $380 billion a year of disasters is rather a common figure each and every year. The vast majority of that in developing countries is not insured. Even though the average is roughly about 50%, the actual figure in developing countries is usually well below 10%, sometimes well below 5%. So in a world of heavily indebted countries, meaning that a lot of countries are having to rebuild and recover, if they do at all, from entirely new money, which they do not have. So that's definitely not a good thing as well. And just thinking about this, because we're in Geneva as well here, if we look at humanitarian needs, we know that the humanitarian appeal from the UN has now sort of settled in and around $50 billion a year. For those of us who have tracked this over the last 10, 15 years ago, I can tell you that in 2011, when I used to do a lot of work tracking the humanitarian dollar, it used to be that humanitarian appeal from the UN was about $6 billion. And here we are sitting on $50 billion a year. Now, it is true that a lot of that is driven by Ukraine, by Gaza and other conflicts. But actually, 40% of that, a stubborn 40 to 45% of that each and every year is driven by disaster, which you certainly can talk about very more comfortably when it comes to things like ex-ante solutions, such as insurance, such as risk transfer. So, and maybe just as a final couple of dollar points before I go into my question to Dermot, we are spending roughly 100 times more each year on humanitarian assistance than we do on ex-ante solutions, on investments in the insurance community, from just the development side of the house. From the development community, and we spend 1,000 times more on development assistance more broadly than we do on ex-ante solutions. Roughly, I would say about $350 million a year on insurance and risk financing, with the entirety of the development system, $220 billion each and every year for broad ODA. And it'd be interesting to hear, maybe from Carolina, what that $300 billion, which was agreed last night, means for any of our work that we're talking about right now. And I'm also maybe just noting here that our administrator released a note on this. He said, whatever it is, we see this as a floor, not a ceiling, when we talk about $300 billion. And that's worthwhile for us to consider. And that means that working with industry is even more important, I would say, because how do we manage this within the limited budgets that we have? And we know we need more. That's part of our conversation here today. But how can we harness much more the talent out there? So here's my question to you, Dermot, if I may, sort of two-part question here, which is, on the one hand, I would like you to reflect a little bit on what I've said and see how you see the importance of the insurance community for these big issues, economic sustainability, stability, particularly in countries exposed to climate change, to extreme weather and other kinds of risks and shocks. And how, if you could tell us how Milliman really got involved in this program, and how does it align with your own mission, your own objectives? So a bit of a two-part one the big picture and one the Milliman picture, if I may.
Yeah, sure. And maybe I'll start with the second half of your question, John, and then I'll maybe loop back into the first part. Why are Milliman involved in this? And I suppose our mission statement in Milliman is to serve our clients to protect the health and financial welfare of people everywhere. And that really links in very much with what you were just talking about financial resilience, and basically providing people with financial resilience to deal with whether that be climate change or whatever type of disasters might happen, be they global disasters, or if I might want to call them micro disasters in terms of challenges that people might have at the individual or family level. So we see that as our role. We've traditionally been very involved with insurers in major economies, if you want to say that, in major countries in Europe and the US and Asia. But we saw an opportunity here, and we could see that there wasn't development happening in many countries, and that the lack of a sophisticated insurance industry and the inability to develop kind of, to get to high levels of insurance coverage. I think you mentioned 10%. I think you said was often 5 or 10% was often the coverage level. So in those situations, you had to say, well, how do we get to an established and sustainable insurance market? And we could see that as economies grow, more complex and more sophisticated insurance markets are needed to deal with more complex risks, to be able to provide security and stability to people, I suppose, that if something happens, the insurance company will be there. In a sense, there's all of that, but also that the insurance companies are able to price appropriately, reserve appropriately, and risk manage the firms appropriately. And one of the challenges when we speak to people in those spaces is, well, we say, well, what's a barrier to growing insurance within your market? And they say, well, we don't have the technical skills to do pricing and reserving and risk management, and we don't have actuaries in many of our markets. So what Milliman saw as an opportunity then was to say, well, okay, how do we work, given our expertise, and we have probably 3,000 actuaries around the world, how can we use those people to help grow the actuarial community in other countries? So that was the challenge for us. And I suppose, when I mentioned our mission statement, the last word we had was people everywhere, the last 2 words. And we were, there were probably about 4 billion people that weren't really being covered by what we were doing. So we saw this as an opportunity to engage with those other 4 billion and provide financial resilience and financial security to those groups. So that was the challenge for us, and for all of our people who had bought into our mission, this was an opportunity for our people within Milliman to say, hey, this is something the organization is doing that fits with my personal perspective and fits with my personal goals. So it was a bit of a win-win. We saw an opportunity to grow and kind of tie into our mission, but also to give opportunities to our people to get involved and to understand other economies and to give back something in terms of their own careers. So that's essentially the background. Like I said, it really is important if you've got things like major disasters, climate change, other things that are happening. It's just impossible for an economy to survive if it's always relying on cash coming from somewhere. I mean, it's the same in any organization. Same. Developing countries have developed insurance solutions for that, so they survive and they can move on. We need to get others into the same space. So maybe I can give a question back to you, Jan, just to kind of get a sense of, what do you see as the role of the UNDP in helping to support robust insurance market in developing economies?
Thank you, Dermot, for your response there. I mean, just before I answer, picking out a few things that you're sort of suggesting. I think one thing which we talk about quite a lot in our own narrative, which is insurance is much more than insurance, and what it means and what it represents. So just want to, you mentioned about financial risk management, and then of course it's the fact that it does protect and incentivize innovation and investment. It's something which we don't talk about very much more broadly, I think. Even the insurance industry is not particularly good at talking about that. I think that is worthwhile noting. And also the fact that I note, and your chairman, Ken, has also said in the past how this actually has motivated. You've had, I think, at times an oversubscription of people that wanted to join GAIN and get involved in this. And that's also an avenue for bringing talent, I guess, into the world of development. So I guess when it comes to us in insurance market development, and my colleagues here will be talking more detailed about how we look at insurance market development in general. I think what we see it is really a building block of financial resilience more broadly. Because we can have sovereign solutions which are more about countries, nation states, or authorities having large-scale solutions for public assets for agriculture. But insurance market development is much more important than that, or it's not more important than that, but it's an important complement to that, because we're talking about ensuring each and every, if you like, family, business, farmer, and for them to have a stake in the insurance, which is really important. But also for us to have a layered approach to risk and to financial risk management and make sure that we don't just cover it from one single aspect. For us in UNDP, essentially what we do is, at the simple level, is governance, and is the technical capacity of governments to actually manage risk financially. So we do that from the public financial management side of things, working with ministries of finance. We work with sector or line ministry, such as agriculture, when we're doing agricultural programs. And then, yes, we're working with insurance regulators, supervisors, and others that have a stake in building insurance markets. And that's really how we look to, do that work as much as we can comprehensively across government. Maybe I'd like to just sort of wrap up here on my side with one follow-up question to this, which is coming back to GAIN itself. I wonder, in light of what I was talking about, the big picture of development and working with governments in terms of their technical capacity, what are the lessons that you've learned and your team has learned about the implementation side of GAIN in the last few years? Both, the challenges, which I imagine there are, and we'll hear about them, I'm sure, later as well, but from your perspective as CEO, and also the opportunities for the future.
Yeah, so I mean, the challenges are interesting. I mean, we've learned a lot. It's a little over 2 years just since we started this program, and we've learned quite a few things as we've gone along working on it. I suppose we were sending out teams to the way we worked is we developed a team of ambassadors who would go to visit a country. They work with regulators, with academics, with the insurance industry, the local actuarial profession, any other groups that are relevant in terms of sharing our knowledge and our expertise, and basically putting a pool and putting a bespoke solution together for every individual country. But what we did learn over time is that there are some tools that are transferable. We don't need to develop the same toolkit over and over again. So, tools that are relevant, whether it be mentoring of students, whether, providing tutoring services, working with regulators on a good regulatory infrastructure, working with universities and putting appropriate programs in place, getting the local community engaged. We found that many of the same tools, if you like, or different methodologies were repeatable across different countries. So we have, over time, developed a toolkit, if you like. Now, we deploy those tools in different ways in different countries. If I kind of put it a bit like, if we have a hammer and a saw and nails and other tools, and in making a table, it doesn't mean we make the same table every time. We have different tools. We might make a small table in one country, we might make a large dining table in another country, but we're able to use those tools in different ways. So that's been good. But what we've also become clear is, and we knew at the beginning, this is a long-term project. Milliman initially committed for 5 years. We're, as I said, 2 years into that, but we realized that it's not about Milliman doing its 5 years and then walking away. This is about working with all of those local countries to develop the skill sets within the countries. So if it's about tutoring individuals, for example, students who are preparing for exams, we need to not just tutor the current people, we need to build the future tutors. If it's about working with universities, it's putting sustainable programs in place. It's putting regulation in place with regulators. So it needs deep work, so that essentially at the end of the program, local countries are in a position to continue on and don't need to continue coming back to Milliman. And we have had huge demand. This year, we've worked with 12 countries. We know there are others who would like to be involved. It's just at times difficult to keep up with everybody. We are open to other partners to come and join us, partly to make this sustainable long term, partly because we know others have approached us and said, hey, we'd love to be involved. So as this grows and develops, I think it can move beyond being Milliman and the UNDP to being something that is much more global and sustainable. And our interest as Milliman, as I said at the start, is really to have financial resilience in each of these countries, to put structures in place, as you mentioned, Jan, to help with investment, to give people the confidence to invest. It's very difficult to invest if you don't have appropriate insurance solutions, and if something goes wrong, you lose all of your investment. That just doesn't lead to investment and therefore economic growth. So that's what we're trying to put in place, a sort of ability to do that. And we've learned substantially about how to do that in different countries. We have a pretty well managed toolkit now that we're rolling out, and you'll hear more about later. And we hope to continue that for many years to come. Maybe
if I could just say thanks, Dermot. In fact, just to say how much we've worked together and how closely, because that last sort of narrative that you gave on the sort of the sustainability piece, I mean, we could have written that for you, to be honest. We didn't in this case. So, I mean, that is good in a sense. We do have this shared vision coming from two different sides. And thank you very much for all of your work. And I'm handing it back to Sandra. Thank you so much.
Thank you, John.
Thank you, Dermot. And really, this is a tribute to what happens when we have effective public-private partnerships coming together. And a reminder to the audience that you will hear more tangible examples of successes, challenges from our colleagues at UNDP and Milliman later in the session. Jan, you mentioned the outcome of the COP29 climate finance negotiations, which came to a close yesterday. Loss and damage, of course, a core item on the agenda, and operationalizing the Santiago network, which will play a crucial role in catalyzing technical assistance for climate vulnerable countries. And with that, we're very lucky to have Carolina Fuentes with us today, who's the director of the Santiago Network Secretariat, just returned from Baku. Carolina, having just returned from the negotiations, I'm sure everyone would be very interested to hear some of your insights. And what we'd also be grateful for is to understand how the network is approaching the role of data, risk modeling, risk transfer solutions to support these climate vulnerable countries.
Many thanks, Sandra, and many thanks also for the invitation to this event. It is very important for us also now following the negotiations in Baku to bring back as well to the audience and also to those following this webinar, what transpired in the negotiating rooms, but also how we as Santiago Network have been created as part of the process to come up with the solutions, or at least part of the solutions when it comes to loss and damage. Now, importantly, when it comes to the financial protection gap, it is a result, of course, of structural gaps, and those structural gaps further exacerbate the vulnerability of countries and also populations, communities, vulnerable groups to further losses and damages. So it creates a vicious circle, also because financial resilience is an indicator that takes us into the future. If we are financially resilient, or if we build financial resilience today, that will ensure also that we will be better able to cope with any impacts, climate adverse impacts in the future. On the contrary, the lack of financial resilience, the financial protection gap, is also a predictor that we will be further exposed and, of course, less able to cope with losses and damages. So there is a need for us to break that vicious circle, and coming up also with solutions that can really place the country and developing countries and vulnerable communities in the driver's seat when it comes with designing the response to addressing losses and damages, both existing losses and damages, but also in the future. That takes us also to the need to come up with the information that can make visible this financial protection gap. And most of the times it is unknown because there is lack of data. And that is also something that transpired in the bilaterals that we have with different developing countries in Baku. One of the essential requests, and that was consistent in many of the exchanges, is that there is a need for data, community or country-specific data that is disaggregated by gender and also provides them with a better understanding of the risk, the vulnerability, the exposure, the hazard. Without that data, they are also unable to come up with responses and anticipatory responses that can help us work on that preamble before a disaster takes place, and not only coming up with solutions after a disaster or a loss and damage has taken place. Data is, of course, one of the requirements for countries to come up with a better way of planning and a better way of designing also their demand-driven responses to losses and damages. But that is only part of the equation. There is also the need to come up with policies, with the institutional frameworks, with regulations, and also the need to come up with awareness campaigns that can help at the country and at the subnational level disseminate how important it is to act on loss and damage, and come up with plans that can also include financial resilience as part of it. Now, let me go to the 300 billion goal that was just recently agreed as recent as yesterday, and there was both a sense of achievement, but also a sense of frustration in many of the negotiators and those that were behind also the new collective quantified goal on climate finance. I fully agree also with looking at this as a floor and not as a ceiling. But also I would like to underline another aspect, that is that the negotiations and conversations at COP also focus on the quality of climate finance, not only on the quantum. So the quantum is what we have in the agreed text, but the quality is also important. And that is something also that we all need to work on collectively from different fronts, including from the Santiago Network, as it relates to having a climate finance that is more inclusive, also that is demand-driven, and where the local actors are seen as agents. And in this respect, also, I celebrate the fact that actuaries in developing countries are being seen also as a critical piece in building financial resilience, and that there is training in the plans also to make sure that they play a role, and they play a role as part of the solution. So an invitation also for continuing looking into these context-specific responses that bring local actors into the scene. That will require also a broader understanding of quality, the quality of finance that is provided, and the quality of that 300 billion, and hopefully more, if we look at that as the floor. That quality also needs to be understood, not only in terms of compliance with investment criteria or compliance with funding criteria from multilateral banks or climate funds, but also quality in terms of climate finance resulting for consultative processes at the national and subnational level, and responding to the needs from those countries and vulnerable communities, financial resilience being one of those needs. Now, where the Santiago Network fits precisely in raising that awareness. Most of times, countries and communities in vulnerability are not fully aware of the exposure that they face, and also the risks and the threats that they have, both when it comes to the existing threats, but also forecasted threats that may occur induced by climate change. The Santiago Network plays a role in providing technical assistance precisely to fill that gap, the gap for countries to have a thorough understanding of the needs, to have the data that they require, to come up with the policies that will help them address those risks, to identify also how to strengthen their local institutions so they can respond to losses and damages. We also support with the understanding of the financial aspect, because here also we have economic and non-economic elements, which of course are difficult to quantify, and we require different methodologies to make sure that there is an assessment of those potential losses and damages that can be economic and non-economic in form. We catalyze technical assistance by matchmaking the needs coming from countries at the local, national, and regional level with a network of organizations which are part of the Santiago Network and are providers of technical assistance. So we are open to receive requests of technical assistance. We have a network of partners, and we do the matchmaking to make sure that the country or the community can receive the best response to their specific needs. Now, we're very happy also to announce, and we did that last week at COP, that the first technical assistance request has been advertised in the website of the Santiago Network, and also in the United Nations Global Market platform. We are open also for expressions of interest of members to become a member of the network and be able to provide technical assistance in response to those requests. So through that, we're also mobilizing that local expertise and tapping into the local expertise to respond to a global challenge, but a global challenge that requires a context-specific response. And of course, that context specificity needs to be mindful of the financial resilience that needs to be created. I will stop here. Thank you.
Thank you so much, Carolina, and all the more from having almost just gotten off a plane to be here. So thank you again. Earlier in your intervention, you did reference that it's not only about data, it's also about sort of the regulatory frameworks, the policies, what we refer to through GAIN and our work in UNDP as the development of the local market infrastructure, which is my segue into now a very diverse and rich panel discussion, which does have representatives from each of these different spheres of effective risk management. And for that, I will hand over to my colleague, Sarab Sharma, who is our Insurance for Development Technical Lead at the UNDP Insurance and Risk Finance Facility. Sarab, over to you.
Thank you so much, Siandra, and thank you, all the speakers. You have brilliantly set the scene, and I think you have underscored the role of data, innovation, partnerships in strengthening the capacity of developing countries to respond to these rising risks. I'm sure our audience is eager to hear how our panelists are now tackling these challenges in their respective areas. As Siandra mentioned, I'm the Insurance for Development Specialist at IRFF, and in this role, I support our country offices in insurance innovation and nature resilience work. And while working with these countries, I've firsthand witnessed the challenges that countries are facing in understanding and managing risks. And that's why I'm very excited to facilitate this panel today, where we'll delve deeper into some of the practical pathways for action. So we'll hear from insurers, regulators, actuaries, development partners on how they are working to address some of these challenges and to building towards a more resilient future. We have an inspirational leader from Africa to start this conversation. I'll welcome Hope Moreira. She's the managing director and CEO of ZEPRI, a Pan-African reinsurer that is pioneering efforts in climate resilience and agriculture insurance. Under Hope's leadership, ZEPRI has provided critical protection for millions of smallholder farmers across Africa. Welcome, Hope. ZEPRI is such a unique organization. It's very uniquely placed. You have both public and private sector shareholders. You are also working with both public and private sector across Africa. So, from your unique vantage points, what steps are both public and private sectors taking to understand and quantifying these rising risks like climate change, health shocks, and maybe you can also talk about some of the challenges they are facing in this effort. Hope.
Thank you. Thank you. Yeah, thank you. Can you hear me?
Yes.
Thank you for having me and really to tackle and discuss issues that are getting worse and worse, globally challenging. So like I always say, it takes a village. So public-private partnership really is the only way we can tackle these things. And ZEPRI indeed does sit at that vantage point. If you think about the kind of risks we're talking about, climate risk, the size of it, unless we are able to bring the governments to provide the right environment, the right regulatory environment, and I'll tell you some of the experiences we've had, as well as bringing private sector expertise, as well as capacity, capital, then you really cannot tackle climate change or the health crisis or the protection gap that we're all trying to bridge. Yeah, so innovation and expertise, data-driven is key, and that's what we've seen. The kind of things we are hearing from Milliman, the actuarial expertise has been very critical to putting in the solutions. But when you think about now the risk we are dealing with, it's unique. In most cases, it's very unique. So you not only need governments, central governments, you need local governments, you need local leaders, you need religious leaders. So it does build a whole ecosystem to be able to do that. Risk pooling, I mean, we do understand that in our industry. We've seen progressively that unless you're able to tackle climate change or such risks at a regional, at least continental level, then it becomes very, very difficult. So that needs not only the goodwill of one government, but a number of governments. And that's what we are doing in one of the projects that we deal with, Drive. Local insurance companies across the board, learning the lessons, getting local capacity, bringing in international capacity. Unless you're able to do that, we really can't do that. We've also seen digital innovation being ahead of that, because how do you reach the currently unreachable or unreached? Scalability, I think, has been a big factor in many of the projects we've seen in the past, that people are we're not able to scale, and therefore we're not able to impact. So you need policy support. And one of the things we experienced, which was quite unique, for example, in the Drive project, which we'll maybe talk about, is that we could not deal with the current distribution channel environment where you have insurance agents selling insurance. You had to have aggregators, you had to have NGOs. This was not acceptable in the regulation. And the governments here have been very proactive in changing that. And through our academies, we're able to train the NGOs, the women groups, to be able to sell insurance. So those are the kind of things that, unless we are able to do that, unless we are able then also to add, because insurance can't be the only solution, right? So how do you make sure that at the end of the day it is integrated in the rest of the disaster risk mitigation processes? In our case, for example, both in the smallholder farmer or even in the pastures, how do you connect them to markets? Because that's resilience, right? So yeah, so there is quite a lot that has to be done, that the private sector can bring on board, which is product development, which is capacity, which is distribution. There's what the governments have to do, and the public sector, and not only that, actually, the DFIs, the NGOs, to be able to bridge this gap that is so big that no one entity can do that. And there are lessons we are learning, and we hope to be able to share them across. It doesn't work. What works in one doesn't work in another. One product here doesn't work in another. Yeah, so I think at the end of the day, everybody has to be brought on. We're talking about policy advocacy. We're talking about funding. We're talking about product development. We're talking about putting in private sector capacity. So it does definitely take public-private partnership.
Thank you for such really interesting insights, Hope. What I'm really picking is that the need is to build ecosystems, and it's not just about the insurance industry, but even stakeholders that we would not normally think of, as you mentioned, religious leaders that I would not normally associate with resilience building. But clearly, I can see the very important role that they play at the local level. And again, I think one bit that you highlighted is around building capacity. So Milliman is talking about actuarial capacity, and you are talking about building capacity of the local communities to even understand risks at their level as well. So some really interesting insights. And I know Drive program, please look it up. And I think, Hope, you'll talk about it a bit more in a few minutes. At this point, I would like to bring in Laura into the conversations to bring in a global insurer's perspective. So Laura Rosado is the head of strategy and performance management at EXA Essential. EXA Essential is EXA's inclusive insurance business, and Laura is one of the co-founders of this business, which is working across 20 markets to make insurance accessible and to close the protection gap globally. Laura is also a friend, if I can say that, Laura. I think, so I want to bring in, like, you can maybe talk a little about EXA Essential and how its focus on making insurance more inclusive. And obviously you are working in like 20 countries across continents. What are the key trends in terms of rising risks that you are observing?
Well, first of all, thank you, Sorab, and all the team at UNDP for having invited AXA Essential to this great panel. I think the line of guests speaking today is quite compelling. I think to your question, the first thing I'll say is alleviate climate change and natural disasters, because in a way this is a conducting thread to this event. And I think we've now established how low-income communities are disproportionately affected with the limited coping mechanisms to this. And I'll take the opportunity in this short amount of time to talk about two other vulnerabilities that threaten the resilience at household level, and that I would say are also intersectional, further exacerbating vulnerability and reducing the capacity to cope with unexpected, especially natural disasters. And the first one is around economic instability driven by occupation. When we think about low-income communities and when we think about their cash flows, this is not only a matter of the amount of income that they perceive every month and whether it is enough to make ends meet, but it is also a matter of the volatility of that income and how much margin of maneuver these households have to face that volatility. Full-time employees with a formal work contract not only have a paycheck that comes every month, but they also benefit from other types of protection, which gives them more certainty about their future. However, with the changes in the labor market, with the increase in occupations in the gig economy space, for example, micro-entrepreneurship and other ways of self-employment, this economic instability really underpins the livelihood of these communities. And when something unplanned happens, it is a, an additional expense. It is very difficult for these households to cope with it. And to take you really to the ground, we recently discussed with a driver working for mobility platforms. He was describing, let's say, more or less his monthly income. And when we started discussing about, an unexpected event and how he had coped with it, he really, the first thing that came to mind was a roadside accident that took his car, to the workshop for over 7 days. And at the time, Luis did not have another coverage than just mandatory liability, paying for third parties' costs. So we estimated that economic impact in three big ways. The first one was he needed to pay for the damage of his car, so adding an additional expense to his monthly income. Second, because the car was in the garage, he could not perceive his daily income. And number three, because he had acquired his car via leasing, he would still need to pay for that loan and that commitment he had made, even if he was not working. And so you can extrapolate Luis's situation to many other occupations. You can think about, micro-entrepreneurs selling clothes in a market, a person working as an electrician, someone working as a domestic worker. And in this specific case, insurance, might not have prevented him from having this unfortunate roadside accident, but it could have definitely provided some economic support to cope with these financial impacts, either, repairing the car or any other working asset, as well as replacing the lost income. And then the second vulnerability I want to make emphasis on is around access to affordable healthcare. And with the changes in demographics, with the shifts in lifestyle, we can expect even greater strain in public systems, especially in emerging markets. And this impacts low-income households, I'd say, in three big ways. The first one is a matter of a barrier of access. So think about geographical distance, number of doctors per person. Think about logistics in terms of the cost of transportation to get to see a nearby doctor. And so when you need to close your shop an entire day to see someone to take care of your health, the most probable result is that you will postpone care. This is the case for a lot of people in emerging markets. The second one, obviously, is quality of care. Even when some services are available, the quality may be inadequate, and this might lead to misdiagnosis, ineffective treatment, further exacerbating health issues. And all these combined is sort of leading to a big financial burden and out-of-pocket expenses for low-income families. So depending on the health condition, these expenses can represent a very large percentage of a low-income household income, and it can even take catastrophic dimensions that can have generational consequences. Some families may even resort to emergency borrowing at exorbitant interest rates or selling assets to cover these medical expenses, leading to this longer-term financial instability. And so addressing healthcare risks is obviously something very difficult to tackle by the private sector or the public sector on their own. It evidently requires a multifaceted approach, but it should revolve around, on one hand, enabling access to affordable healthcare, addressing the out-of-pocket expenditure from households, as well as including insurance as a tool precisely to sort of complement, let's say, this part around medical attention and then financing of it. And obviously, there's room for everyone. There's a lot of space for public-private collaboration that can allow to address these protection gaps in a more efficient way. So I selected these two vulnerabilities. Obviously, the lives of low-income households are significantly more complex and their lives are full of risk. I hope this has given, let's say, a starting point for the conversation.
Absolutely. Thank you for broadening the scope of this conversation, Laura. And of course, while climate risk is getting the due attention, we cannot ignore the other vulnerabilities faced by the households. Like, as you said, like you talked about two of them. And in fact, what we really need is a 360-degree risk profile view of the vulnerabilities that are faced by the households. And then linking it to what Hope was saying earlier, those risk profiles then need to be enhanced at the national level or perhaps continental level, and that's where really the risk pooling aspect of insurance will play into the game. So thank you so much, Laura, for broadening the scope. And I think that's a perfect entry point for our next speaker, who specializes in breaking down complex risks and actuary. So I'll be inviting Elsa Gonzalez, who's the president of the National Association of Actuaries in Mexico. She has nearly 4 decades of expertise in the insurance and reinsurance sectors, with a focus on emerging risks and innovative policy solutions. So Elsa, welcome to the panel. And what we really want to hear is, how are you seeing the actuarial profession evolving to incorporate climate data and new forms of risks into its models? Because obviously we are talking about all these very complex risk profiles that households are facing, and actuaries are the ones who are helping us to, break down these risk profiles. So how do you see the profession evolving, and how are you incorporating these new risks into the actuarial models?
Thank you. Thank you very much for allowing me to participate in this forum. Thank you to the United Nations Development Program and Milliman for this initiative. Yes, it's a very good question, because the actuaries, as you know, have been always been focused on traditional markets and working on their certain areas. But let us remember that actuaries are measuring uncertainty and risk. And actuaries have always worked with data, but the difference in these recent years is that we have now a breakthrough in technology that is allowing us to store more information, to connect worldwide cases, and study common causes or routes for some kind of events. Now, events that were considered rare or becoming more likely or occurring on scales never seen before are seen now. We are receiving historical records every year. We are surprised about the figures and the damages that are being reported for certain potential risks. So now, examining what it if scenarios or hypothetical scenarios are being very, very important. And let me give you some examples. For example, in Argentina in 2013, we have floodings in Rio de la Plata, never seen, with cost more than $1,300 million. But the same or similar effect happened in the Dana recently in Spain with very strongly floodings. How they are connected, or how can we connect them to study? Or let me see you the contrary. We have in Canada a wildfire season last year in 2023 that affected 18 million hectares burned. So tremendous damage, and it's the contrary of this water claim. Or let me tell you, for example, other kind of events that we are facing. You should probably remember the 8 million computers affected by a software update in worldwide, with a huge estimation above the 5.4 billion of claims. So these claims are really surprising each time, and the actuaries need to be working now on how to prevent and make more affordable protections or structures that can rapidly help those affected areas. Now, these kind of events have special characteristics that we see. They have a significant impact. The ability of the actuary or the people studying them is limited. We know little, and they have a degree of uncertainty. And the actuaries are now focusing so much on the climate risk, and the International Actuarial Association started some task force 5 or 6 years ago to study and start to collect information. One of the most important issues of the International Actuarial Association, working with all the countries where actuaries perform, are based into or are focused into main activities. One is to establish or develop international standard of actuarial practice on climate risk. That will help us to standardize or to prepare actuaries with better consistency, to achieve greater consistency. And the other focus of the Actuarial Association is precisely as was commented by the previous presenters, is the information gathering. I mean, it's very difficult to be talking about all these events when we don't have really information. Now, taking that on mind, let me tell you that the Actuarial International Association is putting so much emphasis on working on water risk, because it's one of the issues provoking different type of damage, but they are very important for, as you know, for all the humanity. So we need to take care about that. And this map shows, is a map illustrating the water risk in too much or too little water. You can see that there are countries that are facing really important situations or bad situations on both areas. So Actuarial Association is putting on the hot topic this kind of risk. And let me show you the next slide. For example, in this case, and this hot topic on development, this is the kind of analysis the actuaries are performing on that. For example, studying the water resource, the water risk, and the water hazard, and then implementing a study or analysis. And this is just an example on the climate affection we have, but water is one of the most important. But you can see that the water is also affecting several areas. It's not just the situation of the food element or the production or industry or others. Is affecting several areas, and the actuaries have to consider or to prepare the analysis and check how the food security can be analyzed through this information, or business interruption for all the industry in different countries, spread of diseases, asset damage, hygiene impact, human health, obviously, volatility, or depression on capital markets, unpredictable changes in market, etc. So this is the kind of work that the Actuarial Association is working now through very focused teams, and complementing this work through the different associations worldwide. Why? Because each data, each analysis will let us know to understand what is coming or what can happen and measure that. It could be, for example, what will happen or how a flood or hurricane can increase for each degree on temperature we have on the planet, and then try to study on how the concentration of people, because that is also important. We are more concentrated in different areas, how this can affect this population. So what I can say you is the actuaries are really concerned, and we are working. The most important, I will say, value for everybody is to work together, connect information, to establish patterns and models that can be helpful for everybody, and implement, as I told you, this kind of standards, actuarial standards, that can help and support actuaries providing services on the climate related disclosures or risk. So I will say you that yes, the actuaries are really working on that. They are concerned and trying to identify all these situations and help different areas through the insurance, through the public policies, to work with the governments on those. So I will say that.
Thank you so much, Elsa, and thank you for giving us a live example of how actuaries are breaking down complex risks like water, and how the International Association of Actuaries is working together. And that's great to hear that actuaries from around the world are coming together to break down and understand these risks better. And I think this is a great narrative that this discussion is following. We heard from, of course, our initial speakers on the global perspective and what COP29 is doing around it. We heard from Hope and Laura around the regional and the global insurers perspective. And I think our next two speakers will bring in the enabler side of thing. And the first, let's hear from the regulator's perspective. We have Poojan Adhikari from the Nepal Insurance Authority, the Insurance Regulatory Authority of Nepal, where she's a director. Her major areas of responsibility are product development, actuarial valuation, and approval of insurance policies submitted by the insurer. So she's clearly has a big remit as the regulator in Nepal. Welcome, Poojan. And I think we want to hear the regulator's perspective, like what role are regulators playing globally in enhancing the understanding and quantification and pricing of risks? Poojan, yeah, you're muted. Yes. Thank you.
Thank you, sir. Thank you for the question, Saurabh, and thank you UNDP for the opportunity to be the part of this wonderful event. Yes, indeed, the insurance regulators play a vital role in safeguarding the interest of the policyholders and in ensuring the overall stability of the insurance industry. And since we all know that Nepal is highly vulnerable to disaster and climate-related risks, so regulatory frameworks are most important tools that can be used to ensure that the policyholders are protected and the insurance industry is also stable. So to give the example of Nepal, Nepal Insurance Authority has issued various directives and guidelines for the industry. For example, a risk-based capital guideline, risk management guidelines, underwriting guidelines, and product guidelines. These all guidelines and directives are key to provide the information about the risks to the industry and to the policyholders as well. And another important thing the regulator can do is to organize the interaction programs with the insurers, with the local governments, and with the board of the insurer, with the intermediaries, and also with the other stakeholders as well. So that part is very, very important to enhance the understanding of the risks. Similarly, another important thing the regulator can do is to collaborate with the international organizations like World Bank, UNDP, and A2II, and other international organizations to adopt the international best practices in the regulation as well. And one most important part that I see is to encourage the innovation, because innovation is very, very important. So as a regulator, we should promote the new innovative products like the parametric insurance product in the non-life insurance. Similarly, the regulator should encourage to adopt the new technologies and business models. And some of the examples are in some jurisdiction, there are regulatory sandboxes are in place. We are not using regulatory sandbox till date, but we are having discussion to introduce the regulatory sandbox in Nepalese industry as well. And flexible regulatory frameworks are under the enabling factor to create the enabling environment to the insurers. And one most important thing is to develop the technical expertise in the insurance sector. For example, in the developing country like Nepal, there is a lack of actuarial, expertise. So to build the technical expertise in insurance sector is also the important role of the regulator, because the technical expertise like actuaries are very, very important to build the mortality table, morbidity table, and to develop the various catastrophic risk models and earthquake and flood and other risk models in the industry to ensure the proper pricing. And similarly, the regulators should be proactive to implement the risk-based pricing. Nepal is also in the process of implementing the risk-based pricing. We are trying to move from the conventional pricing method. We have tariff-based pricing till date, but we are moving towards risk-based pricing to make the pricing more, scientific. So I should say that the regulator can play the role of the catalyst in understanding the risks by organizing the insurance literacy programs, which help the policyholders to understand the risks and help them to make the informed decision. Similarly, the regulator can develop the different sources of information like web portal, mobile apps, in the interactive voice response system, IVR, and also develop the radio and TV programs. The regulator can conduct the research-related activities and make the relevant data and publication available to the public. And the regulator can also help to disseminate the information by collaborating with the educational institutions and actuarial societies. So I should say that the regulator must take the proactive approach in identifying and analyzing the emerging risks while adopting the international best practices to manage them effectively. And we as a regulator, and I always follow the guidelines issued by the IAIS, International Association of Insurance Supervisors, which is the standard setting body with more than 200 member jurisdictions. So to summarize, I think that the regulators should prioritize on creating the enabling environment for the insurers and to safeguard the rights and interests of the policyholders, and also should be able to adopt best practices. Thank you, Saurabh.
Thank you so much, Poojan. And I mean, thanks for highlighting that the regulator's role is not just setting regulations, but to play an enabling role in the industry through capacity building or through awareness generation and all these, and supporting innovation through sandboxes. And we are seeing regulators taking that path more and more. So I think thank you so much, Poojan. And now that we have heard from insurers, reinsurers, actuaries, regulators, our final speaker ties it all together. With the COP29 having just finished and so much focus on climate finance, I think, Mark, everyone is super keen to hear from you. You can help us understand all this conversation that is coming out of COP29. Mark Davis is the head of disaster risk finance for FCDO in the Public Finance and Tax Department in the UK. The DRF team at the FCDO oversees UK support to the Center for Disaster Protection, World Bank's Global Shield Financing Facility, African Risk Capacity. So really some of the biggest global programs around building resilience. So Mark, welcome. And in light of this growing need for resilience building, and as I said, this conversation around climate finance, how are you seeing the broader financing landscape evolving to meet this challenge?
Great, thank you, Saurabh, and UNDP and Milliman for the opportunity to speak today, and for all those joining. I've really enjoyed the discussion so far, so great to be a part of it. I guess I should start by saying that we support calls for scaling up climate finance to meet the challenges that we've heard so far. I think disaster risk financing is a key component of our response to loss and damage, but also part of the global climate finance funds for adaptation. So certainly in relation to additionality, in terms of additional funds that are needed. But I think the first point to consider really is about considering efficiency, and that's basically doing better with what we have. So I think that is why the discussion on increasing the amount of pre-arranged finance that we spend on crisis is important, and that's so clearly set out in the Centre for Disaster Protection's reports on the state of pre-arranged finance. So I think I want to like us all to consider how we can make further commitments on pre-arranged finance and close that gap, which Jan described so well in terms of the comparators on spend. And Laura also gave a flavour for that protection gap as well in more a real sense. So that's why the FCDO in the UK is committed more to spend more on pre-arranged finance in the white paper for international development we released at the end of 23. But we all have a way to go in terms of that gap. I think secondly, just like to emphasize how I think we need to situate the discussion on pre-arranged financing and disaster risk finance in the context of broader financial considerations, and particularly global financial system reform. So Jan mentioned the SDGs right at the onset, at the beginning, and a lack of reference to financial resilience. So I think specifically we need to consider how disaster risk finance underpins the work to close, I think, close to $3 trillion annual financing gap we have in reaching the SDGs in low and middle income countries. So I think when we're considering how we need to close that gap and scale up domestic resources when we're discussing whether it's tax or private sector development, alongside calls for scaling up international public finance, whether that's grants, loans, and others, international private finance. I think we need to think how we ensure that all of that finance is more resilient and responsive to shocks. And I think situating this discussion around prearranged financing in that context enables us to be part of and influence a much wider agenda. So that's where we're engaged in conversations around Bridgetown 3, for example, financing for development coming up next year, G7, G20, and many other, obviously COP and other discourses we're engaged in. It's situating it within those wider calls, I think, will have the greatest impact. Thirdly, I think it's, and the final point, set of points is around considering what we need to do with this money. So quality was mentioned by Carolina, but to do this, I think, to ensure we make the money go the furthest, we need to think comprehensively and look at the system as a whole. And quite a few speakers have already referenced that, I think. In terms of the work for FCDO is kind of located around 3 areas, 3 A's as it were. We look at advice, we look at access to disaster risk finance, and we look at the wider architecture. So just through those 3 briefly, in terms of advice, that's helping countries and organizations understand the risks that they face and the tools available to respond. We do that through organizations like the Centre for Disaster Protection, but multilateral development banks, and the insurance industry and partners like the government's actuaries department in the UK. And I think, as was mentioned earlier, you know, this is the point being risk identification is the foundation for all that we do. And before we come to the solutions, as Carolina and others have mentioned, I would also emphasize the focus on kind of independent advice at the country level on what is most appropriate has been a key part of that. The second bit of advice is around ensuring that the support reaches those that need it the most. So that kind of final mile delivery piece, looking at preparedness, system building, opportunities for earmarking to existing successful schemes like social protection, all of what the CDP call the money out piece, but that's critical in terms of the advice. And we do that through risk pools themselves who do work on preparedness, MDBs, the NGO sector. I saw a reference in the chat about the role of NGOs. They're playing an increasing role in, particularly in the humanitarian sector, supporting this agenda. The second A, so in terms of access to disaster risk finance and insurance, I think development partners have a role to play in helping countries, but also organizations and people access insurance. We do this in the UK through capital that we've provided, particularly to the regional risk pools, and we provided investment to the Africa risk pool, the Caribbean, and most recently announced at COP in the Pacific. So that capital is really critical in terms of the risk pools expanding their offer on new insurance products. And I think Hope was mentioning the benefits of kind of pooling risk regionally. But then premiums, in addition to the capital, has been an increasing part, and development partners have increasingly been willing to provide premiums and subsidies over the last few years, particularly to low-income countries to help them afford insurance, but also increasingly as well subsidizing humanitarian organizations. And FCDO has provided about 135 million in premium subsidies over the last few years to quite a range of partners. And the final piece I'll finish on, Sarah, is just on the architecture. So we work with a number of bilateral partners, MDBs, the insurance industry, and that's really about developing the architecture that provides the tools we need. So that can be around strengthening the regional risk pools, which really do, we think, have a key role to play. And we've seen that in addition to sovereign support being expanded as well for replica programs for humanitarian agencies has been really important to reach parts and geographies that we haven't been able to before. The second is around kind of MDB reform, ensuring that they're offering the right set of tools for countries, that they're partnering and offering kind of preparedness as standard. And then the insurance industry, we've heard a lot about that, how, you know, partnerships to leverage their expertise in understanding and assessing risks and developing new products, but they're an increasing part of the architecture that we've heard throughout the session today. And then finally, as development partners, you know, how we need to be committed to coordination, collaboration. The success of this agenda has seen more actors, more players, more on offer, but that has also led to fragmentation in some places. So how we can come together, whether that's through, you know, premium subsidies or how we provide our capital, how the people like the UN, who are increasingly got an offer in this area as well, are coming together, so that we're making the life of the countries as easy as possible. So just to conclude, it's a busy area of work. I think huge interest and huge demand, but challenges and a long way to go. But I really liked how the discussion was talking about thinking, you know, creatively, thinking innovatively, thinking how there's new expertise we can draw on that Jan mentioned at the beginning. I think that's key in terms of our engagement with the industry on this agenda. I'll stop there. Thanks.
Thank you so much, Mark. I think you've really, as I said, you really brought it together. And also, it's really good to hear about all the live examples on how FCDO is supporting all these regional risk pools and the excellent work they are doing. At this point, we are, of course, at the midpoint of the panel discussion, and I, as the moderator, has done a very poor job of timekeeping. So I'm going to ask all the speakers to be extra quick in the second round. We don't want to lose out on the second round where we are going to talk about some of the live examples. So I do want to touch on that, but I'll request speakers to be very brief. At the same time, audience, we are seeing some really good questions coming in. So I encourage you to share even more questions. Even if we are not able to touch on them during the discussion, we'll definitely share those with the relevant speakers and come back to you. So please share more questions. I also see my colleagues sharing some really interesting resources that link to different speakers' work. So please take a look at those resources as well. And now jumping very quickly into the second round, and this is more about practical examples. So what we want to hear from the speakers is about some of the programs and the insights that they have had. But because of my poor timekeeping job, I'm going to request if you can really sum up your answer in like less than 2 minutes. If it goes above 2 minutes, my colleague Sianda is telling me she has some really annoyingly sounding buzzer that she's going to sound. So with that cautionary remark, Hope, I'll go to you. I think you were talking about Drive, which is like such a unique program, building resilience of pastoralists. So what has been the experience and how are you pricing this unique risk in such a difficult context?
Thanks, Rabi. I think you'll agree that I'll have another 2 minutes from my previous conversation, but thank you so much. So Drive is, like you put, the world's largest initiative to build climate resilience for pastures, right? It's a regional program. We're covering 4 countries that has allowed us to scale. And when we look at, you know, how did we go about that? It's a World Bank funded 360 million that not only is really a risk pool, it's also building the linkages to markets, which I did talk about before, that really does build that sustainability. So we did a balancing act of how do we understand the local needs, the needs of the pasturists, especially when you think about the cultural norms that are different. And how do you balance that with really having hardcore data, actuary expertise that does bring a world-class product? And that's what we did. We had community engagement. We had lots of extensive feasibility studies around engaging with the pastoralists. What is it that works for them? Understanding how climate risks affect them individually in different demographics. How does it affect women? How does it affect the youth? It was also a partnership-driven design. We leveraged expertise in Kenya and Ethiopia, where there had been country programs, CLIP in Kenya and CIPE in Ethiopia, and what are the lessons that had been learned, what are the patterns for drought. Think about all the data you can do, livestock mortality, behavior. Then we brought on international expertise from global reinsurers like Swiss Re, who are participating in this pool, and all this. The pricing had to take into account scalability as well as alignment to of course, the goals that we had of financial inclusion. Data, can't say less about that. We partnered with Planet, which is a leading provider of the satellite imagery to get advanced data in designing an index-based livestock insurance product, looking at rainfall patterns, etc. And then, of course, actuary expertise, right? We had support from the UK government's actuary department, to peer review and look at global best practices. So all this came into creating something that we think is robust and sustainable. 2 years down the line, we are well beyond our targets. We've hit about 3 million pastoralists and their families, and mobilized over 250 million private capital into going this. But also lessons are learned as we go. Some things work, some things don't work. So we calibrate. In particular, we found that the vegetation data for Puntland in Somalia was not correct. So we had to pull off the product and rethink how to do so. It is an ongoing process, good success so far. And it does take a lot of everybody's input. The DFIs have been great. I'm happy to hear from FCDO, one of our funders through the Global Shield, on managing this project. So, and indeed, not related to this question, I liked the last bit that Mark talked about of how do we make sure that the intervention is not fragmented, because the problem is so big. So thank you so much, and I hope that's useful.
Thank you, Hope, and thank you for rushing through your response as well. Audience can learn more about Drive in the chat, where a link has been shared. Laura, coming to you, I mean, you talked about the micro and the household level risks, right? Maybe a quick example from EXA's very extensive experience.
Yes, really quickly, I'll do it as quick as possible, Saurabh. So I think, there will be some links shared with more information on some of our recent initiatives. And I would just highlight, in terms of addressing the fragmentation point and also in addressing such a huge protection gap, is that collaboration, public-private, private-private, is actually critical. And even for us at the last mile, identifying those organizations that are already serving low and middle income communities is a critical point to really aggregate and allow us to reach as many customers as possible. And the example that I want to focus on is a partnership that we have with a financial institution in Colombia called Banco Mundo Mujer, where we provide a comprehensive cover that is linked to the productive loans portfolio. And it includes insurance against death, but also critical illness and permanent disability. This not only removes the debt burden from the borrower, but it also provides some economic compensation, especially in the case of critical illnesses. And this is already covering over 500,000 of borrowers of the bank. And we are in the process of implementing the possibility, giving the customers the possibility of not only insuring themselves, but also insuring their spouse as part of that program. And we completed an impact study in 2024 that I think really puts in perspective the role that insurance can have on improving the livelihoods of these communities. In terms of who we serve, something that I would highlight is that we are in majority reaching women over 46 years old of age, and of which 80% of them had up to high school education. From a financial vulnerability perspective, they were first-time buyers of insurance. So this was their first experience having an insurance product overall, which I think is something very telling in terms of the challenge that we have ahead in creating an insurance culture, is that we have to assume that the coping mechanisms and the competition that insurance companies have today is not other insurance companies, but is really these informal and less efficient mechanisms to cope with risk. At the same time, 4 out of 5 people within the interview sample highlighted that they would not be able to find a similar coverage outside of what they are getting with Banco Mundo Mujer. And more importantly was, when thinking about financial resilience, 7 out of 10 of these respondents said that they would not be able to have afforded to face this emergency without insurance. They would have needed to borrow, to sell assets, etc. And so when we spoke to the claimants more specifically, 72% of the people that had filed a claim, either the beneficiaries or the borrowers themselves, 70% reported not having had saved money on the last 3 months. So their margin of response was very limited. And basically 87% reported that insurance helped them manage the expenses. So with this, sorry, am I out of time?
Yes, sorry, Laura. We have 4 minutes left, and I'm blaming on Sarah for being so interested in rich discussion that I think having to keep time at the same time is complicated. But we don't want to miss out on the call to action. The good news is all of the questions, all of the remaining insights, I will share some of the blame with Sarah here, but everything we can sort of package up and make sure that we, on the UNDP and Milliman side, can commit to putting that together in a follow-up to our over 200 online speakers, over 500 people that registered to join us. But we might just jump over, Sarah and panelists, if you'll permit us, jump over to our closing call to action now, which will be delivered by Miguel Solana on the UNDP side and Steve White on the Milliman side. So over to you guys to also wrap up in a record 3 minutes.
No, I'll be very fast. So thank you, everyone, our panelists, for the really interesting discussion. And I think one of the key elements that we take from this is really about, like, we need more understanding of the risks, and we need to do it at the country level where things are happening. So pretty much from the game perspective, as we started this, we were going into totally new territory, bringing a bunch of stakeholders together that had never worked together. Very different situations in all countries, but there was a very clear thing. And that is that the demand to strengthen our understanding about risks and how to manage it is huge. And therefore, today we know together with Milliman how to do this. I think the GAIN has evolved as I would say, as a grassroots initiative that really has a wealth of interventions that goes from academic programs, certification processes, driving capacity transfer through mentorship, and so on. And we need more of this. And I think this is reflected by the demand from new countries about wanting more. And therefore, I really want Steve, who has also been very involved in the implementation of this, to really close this this webinar with some of the key elements that we have been working together. Steve?
Thank you, Miguel. So yeah, I'm an actuary at Milliman after a long career at Milliman. I'm now focused on GAIN, and it's been a fun experience. And what I really want to do is ask you, particularly if you're an actuary, to join us and be part of the GAIN team, working as an ambassador in the countries that we're serving, because we could do more if we have more people. So I've been involved with GAIN for a few years now. I was the CEO at Milliman, and after I stepped down from that role, this is kind of a cool way to end my career. But just to give you a flavor of kind of what we're doing in different countries, we work with UNDP folks, and we work with the stakeholders in the country. So those stakeholders typically are going to be the local actuarial association, the local insurance association, the major insurers in the country, and the universities. So a few of the countries I've been involved in, I did work with a team initially in Nepal, so got to meet Pujan there. So in Nepal, there was one qualified actuary in the country. So the big challenge there is how do you go from that to something that's a more robust actuarial profession? And even within the employers, it's like, well, if we hire an actuary, they don't have anybody else to work with. Who are they going to learn from? So one of the key interventions there was an expectation and a requirement that the regulatory office helped put in place to basically say that they want to have an in-house actuary at each company, even if that person would be an actual analyst, but that person would be involved with the signing actuary, which typically was from another country. But that's how you can start to grow that capacity, by having somebody involved. Another country I've been involved with is Ecuador. Ecuador is a little bit further along, but still quite limited. They need more. In Latin America, the universities are a key part of growing the actuarial profession. And in Ecuador, there wasn't any universities that have a program. So we've been working with them. They have an initiative now. They have a master's program in place at a university, which a lot of the stakeholders there really were making that happen already. So we've been involved and will continue to be involved in supporting that. Also working with the regulator in Ecuador, where there's limited actual capacity at the regulator, and that's kind of a common situation. Nigeria is another one, much bigger country, certainly in terms of population, a much more mature actuarial association. We've been very involved with them. They've been great, but they need more. They need more actuaries there. They need more support at the regulatory office. Also, like not just the insurance regulator, but the National Health Insurance Association. We're working with them. Their pension commission. We've been supporting the local actuarial association with mentoring and tutoring, and with the idea that long-term they're going to be leading that and carrying that on. And we've also had some training with the insurance association, with the regulator. And then what I'm kind of going into next is Pakistan, which is a little bit different because they have a strong supply of actuaries in Pakistan, but they typically are worked in outsourcing roles to support other countries. So their goal is really to help grow the insurance capacity within Pakistan. How can we and what can they do from a regulatory framework to encourage those actuaries to support the industry in Pakistan and have an expectation to have actuaries in Pakistan? So a lot of different challenges in the different countries. It's fun to work in it. It's fun to work with the Milliman team, and we've also brought in people already from other companies. The IAA has been great in supporting us, but we need more help. If you're out there and if you're an actuary, you want to join us. And a lot of the people that join us are on interventions. So that's basically like a part-time or a temporary initiative to support one of these goals. We'd love to have you do that. If you have experience on the regulatory side, even better. That's because those are some of the key roles that we have. So individuals can support us. Also, if you're companies out there, we would love to have partners at the company level to play a big role. And I think, as Miguel said, there's a high demand for the work that we're doing. If we have more people, we can do more for the countries that we're in, but we can also extend and bring in more countries. And I think that if you're interested in helping, you can reach out at gain at milliman.com, I believe is the email address we're looking for. So again, that's gain at milliman.com. So thanks, Miguel, and I hope we can have more people join in this great initiative. Thank you.
Thank you, Steve. Thank you, Miguel. Thank you, everyone, for staying with us. I think we were probably a little too ambitious in trying to pack in so very many different perspectives and sectors and projects. But perhaps that means we just need to further this conversation. Please do reach out to us if you can get involved and help gain submission. We will be sharing a follow-up to everyone that has attended this session. And if you do have a couple of minutes, I think my Milliman colleagues will share a very short video that they have set up titled Solutions for a World at Risk, and that kind of ties in all of these converging risks and some of the solutions. Thank you so much again for joining us. Goodbye, everyone.
Risk is complex and unpredictable, but it's also vital because risk and progress go hand in hand. Since 1947, Milliman has developed leading solutions in healthcare, insurance, employee benefits, and financial services. Our deep expertise in advanced technology help clients navigate the urgent, high-stakes challenges of today's world. From managing the impact of extreme weather on companies and communities, to advancing healthcare innovation while confronting rising costs, to providing financial security, not just for the few, but for all. These are difficult challenges, but solving difficult challenges is what we do. We are a global team of more than 5,000 professionals, driven by a passion for innovation and inspired by a common mission: to serve our clients to protect the health and financial well-being of people everywhere. Milliman. Solutions for a world at risk.